All right, teammates, it's that time. It's that time. Are y'all ready? Are y'all ready? I think I'm stretched. Oh, I'm ready. See, I'm not even in my seat tonight, man. Super J, I'm up moving around because it's going to be that type of night. I hope you guys are fired up, locked and loaded, because what we're going to talk about tonight, teammates, is something that we need to address. We definitely need to address, right? And so I'm going to share my screen. And man, we talking about breaking down trash value life insurance part one. Part one, breaking down trash value life insurance part one. See, teammates, it's a lot going on when it comes to life insurance. I didn't think that that was the case, but I started hearing a rumbling that was happening, So what I'm gonna do tonight is I'm gonna lay the foundation of certain policies. And then next week, what we'll do is we'll take a deep dive into this concept called infinite banking, right? We're going to talk about just trash value. I call them trash value policies, but the technical name for them, the actual name for them is cash value policies, but we've nicknamed them trash value policies. That's what they are, they trash, right? And so, so I'm going to talk about those types of policies tonight. And then we'll take a deep dive into a concept that's really starting to make its rounds on social media and on YouTube and all that type of stuff, a concept called infinite banking. We're going to deep dive into that next Tuesday. I couldn't do it all today because there's so much to cover. So I'm just kind of splitting it up into two different sections, right? And so breaking down trash value life insurance. So this is the deal, guys. We thought that we had pretty much won people over in terms of knowing the right type of policies to purchase. There was still that stuff out there, but there had just been such a groundswell of information about how those policies were not the best policies to own that we felt that our work really wasn't out there as much. Now, this stuff is still being sold. It's always being sold, but it just wasn't being sold as much to people in our community. I'll be honest with you, I would find policies out there rarely. And our national sales director, he put it best yesterday on our leadership meeting. He said, man, most of the people in our market, what we were confronting is people that had no knowledge about owning life insurance outside of their job. So our biggest competitor was just the job insurance, right? That was our biggest competitor because we were in a market to where people, Kimberly Lewis, they didn't really own a lot of life insurance outside of their job. So we just had to educate people on the importance of having life insurance outside of the job, which was a very easy thing to do for the most part. But this is what's been going on, right? So I don't know if you guys know this, but there was a U.S. Senate report that was done June 23rd, 1992. In this Senate report, there was a Judiciary Committee that was formed to really look at cash value life insurance. And in that report, it was a scathing report and indictment against companies that sold whole life and different universal life type policies and how those things were a ripoff. Listen, this is a U.S. Senate report that came out in 1992, June 23rd to be exact, 1992. And they named some companies that were in there. There were more, but they took policies from each of these companies, Guardian, Hartford, New York Life, Pacific Mutual, all these different companies, and they examined their policies and they said, man, this crap is a ripoff. Y'all ain't hearing me. The U.S. Senate said that, right? And there was several different articles that came out. This is one particular article that I wanted to highlight, but a lot of the financial stuff that's out there, they talked about the difference between term versus whole life. And this is an article, it's from CNN Money. It says, choosing a life insurance policy, right? And in this article, I don't know if you can see this, right? It says life insurance is a highly competitive business in which the sales force depends almost entirely on commissions. Check this out, Shadera. It says the life insurance, the sales force depends almost entirely on commissions. Life insurance companies pay fat commissions for selling whole life policies. Oh, y'all ain't hearing me. Life insurance companies, I'm reading the article word for word. Life insurance companies pay fat commissions for selling whole life policies. Perhaps 80% of the first year's premium goes to the agent. Did y'all hear that? 80% of the client's first year premium that they're paying month in and month out, that first year, 80% of that premium goes to the agent. Commissions for selling term policies amount to roughly the same percentage as the first year premium. But since whole life premiums are much higher than premiums for term policies for the same death benefit, they can be 5 to 10 times more. Agents make much more money selling whole life policies than they do selling term. It's no wonder, listen to this, that agents push whole life policies as if their livelihood depended on it. See, these agents are out here, they're not selling these policies because they're good for you. They're selling these policies because it's good for them and their bottom line. Does this make sense? Guys, I'm not making this up. This is stuff that's already out there. This is public. You can Google this stuff, right? It's what it is. But I'm a Star Wars fan, family. And even in the midst of all the several videos that have come out, you can look at YouTube. You got Dave Ramsey and Susie Orman that have made video after video after video, just talking about the evils of cash value life insurance. So many videos out there on YouTube. You know, Susie Orman out there. These are considered well-respected financial experts. But I'm a big fan of Star Wars. And if you guys are big fans of Star Wars, I've seen all the movies several times. There's one of the favorite lines in the movie, Marcellus, and they say it at some point in all of the movies. They say, I felt a disturbance, a great disturbance in the force. I felt a great disturbance in the force, meaning that something's in the air. Something's wrong, right? And I've been feeling this great disturbance because I'm a Jedi. I'm a Jedi. I'm like, what is going on? I'm getting phone calls, random phone calls from friends and clients talking about, hey, Bracy, hey man, what's this stuff, this whole life stuff? Just random calls and questions and text messages. And Super J, I'm like, I sense a disturbance in the force. Auntie, I'm like, where is this coming from? What's happening? Shadrick, I'm like, what is going on? Right? And then I started getting these forwarded messages. And this is what's going on. This is the disturbance that's in the force. So you got all kind of stuff that's out there now on social media platforms, on podcasts, on Instagram, on TikTok, on YouTube. And I want you guys to notice something. When you look at these pictures of people that are talking about cash value life insurance as a wealth building and creating product, as though it's the best thing since sliced bread, who are the people that are talking about it? And what do they look like? They look like you and I. They're young, they seem credible, they're vibrant, and they're talking very passionately about something that is destructive financially to our people. But this is a new face. This is a new disturbance in the force that's going on right now. You got Waka Flocka. First time I heard this, I got on an appointment with an agent and he was talking to somebody and the gentleman said, hey man, I was watching this video and the guy Waka Flocka, he was talking about how he was using life insurance to create wealth. Y'all, I thought it was a cat. I didn't think he was talking about the rapper. I thought it was another guy that was out on social media that was calling himself Waka Flocka. I did not know that it was the rapper or the ex-rapper Waka that was out there talking about generational wealth through a life insurance policy. I watched the videos and I was like, this is crazy. This is crazy. And then on top of that, you got all these other people, man. You got nice little couples trying to look like y'all partnership, Justin and Brittany, you know what I'm saying? Out there talking about how infinite banking works in 2022, right? And then look at this right here. Some on Instagram. Cat got his platform all out there. You can borrow on your life insurance policy with the money bag. You even got a young brother in there. He got a whiteboard, a dry erase board on there using Index Universal Life for infinite banking. And you got a cat sitting in his vehicle. You know, he got the beard going, looking real like, you know, millennial fly, talking about how to avoid paying taxes and make money using life insurance on TikTok. Y'all, this is bad. But what we got to do is we got to mix the bad. We got to come at the bad with the good, because this stuff right here, this is the stuff that put our community in a crutch for a long time. And if anybody's going to be out there on the front lines to mix it up, hand-to-hand combat with this bad information, it's going to be us. It's got to be us. Because if it's not you, then I'm telling you right now, your family is going to mess around and see a couple of messages on social media and think that this stuff is legit. And they're going to get captured by it. Because you know why? Because unfortunately, minority people, we so gullible for things that we think that we can put a little bit in and pay us a lot of money. It's just what it is. It's what it is. And so we out here with bad information, not even really understanding how it works. And we thinking that this stuff is going to make us wealthy and rich. And we get these policies and all that type of crap, putting all kind of savings into them and things like that. Ridiculousness, man. And then we're going to look up 5, 6, 7 years from now, and that stuff ain't going to be working. And they're going to be trapped in that stuff. But we got to be at the front lines of that. Super J, talk to me, man. What you think about this so far, man, and what you've seen and what you've experienced in this world of social media and what's been happening. And what do you got to say about it before I move on?
I mean, in terms of the social media, I mean, it's like spreading like wildfire. You know what I mean? And whatever is the hottest thing, or if a person is just looking like they winning out there, and then they're putting this misinformation out there, and they have this large following of people. You know, I always say the community is full of people that are misinformed and uninformed, right? So the uninformed people, they haven't been told anything, right? And usually when you don't know anything, you don't do anything at all. You kind of stand still. And then you have the misinformed people. But the misinformed people are recruiting heavily, right? And so when the misinformed person gets a hold of an uninformed person, what happens to the uninformed person? You guessed it. They become another misinformed person, right? And so it's just happening over and over and over again. So us as crusaders, right, in Primerica, teaching the right type of stuff to the people out here, right? Really educating them. We need more licensed agents. We need to get more fired up about what we're doing in this company and talking to our people, right? Because if this information isn't coming through you, they're looking to become another misinformed person. Y'all with me? And so, I mean, to make a long story short, my barber that I sit down with, I built a relationship with him for about 2 years before I even told him what I do, okay? He has a very, very, it's like a Wakanda over there. It's Joe Black Barbershop, just to let y'all know. But an incredible barbershop I've been looking for all my life, y'all. I did not even know this existed, you know what I'm saying? But a businessman, a family man, a husband, all that good stuff, right? Good guy. But he was just sold a variable universal policy, you know, and he was just taught the wrong information, and he had it since 2009. And he really believed in that policy, right? And he told me that after I actually helped his family, he said, I can't tell you how many people have come to me and tried to tell me, hey man, I can save you money on your life insurance. I can do this, I can do that. He talking about they be having suits on and everything. But meanwhile, me coming in there with t-shirts, shorts and flip-flops just to get my hair cut, I carried myself the right way, right? I'm talking about the right things, right? So he knows that I'm about something, right? And I approached it the right way, okay? So these are the things that you'll learn in training. But saying all that to say, that's another family that we were able to help because he was heading off of a cliff in a bullet train and he didn't even know it. So him and his wife, they are super excited, man. Got them the right type of policy for their family, right? The money that they had in that building in that policy, it was just getting ate on. You know what I'm saying? Year after year, right? So we put that in a better vehicle form. And so, yes, what we do here is real, y'all. It's real. And what they're doing is real too. And it's just messing up a lot of different families out here. So let's not get weary in what we're doing here, right? Let's just stay fired up and let's search for those yeses. Let's continue searching. Keep looking.
Fantastic, my brother. Thank you so much. I'll be kicking it over to you from time to time during this training to put something on it because you got a heck of a perspective, my guy. And make no mistake about it, family. You know, these people are trying to posture and position themselves as financial experts and things like that, and that they have people's best interests at heart, that they're trying to give people free game that wealthy people have been living by for years. And this is just something that, you know, that you have, man, this stuff has been around for decades, And make no mistake about it. The bottom line motivation for all of it is not so they can help people and put people up on free game and help them create wealth. No, the primary motivation and the only motivation for it all is the money. It's a glorified sales pitch to get people through the door seeking bad products so they can get paid. That's all it is. Are y'all with me? That's what it is. And so what they've done is that they put lipstick on a pig, on the same old pig. That's what they've done. They tried to dress it up. They called it, man, they're not even calling it life insurance a lot of times anymore. They're calling it, hey, it's your family bank. It's this, that, and the third. They're not even calling that. They're calling it not even a policy. They're calling it a concept, right? But they're putting lipstick on an old pig to try to convince a new generation of people to come through their door and buy the wrong product. That's what they're doing. And so let's talk about it. This is a book that I want you guys to add to your library. It's called The Mortality Merchants. If you don't have this book, you need to have this book. If you're going to be in the financial services industry selling life insurance, especially the buy term invest the difference concept, this is a very, very good book to have. It's The Mortality Merchants, the legalized racket of life insurance and what you can do about it. It's by an author named G. Scott Reynolds. I'm going to put this book up a little bit later, right? But in this book, he tells a story. I just kind of brought the story up to modern times, but he talks about the tale of two families. Follow me on this, guys. This is the tale of two families. Check this out. On February 14th, 2022, this year, Jason, a 27-year-old teacher, husband, and father of two, was laid to final rest at a cemetery outside of Seattle, Washington. He passed away, and they had his funeral on Valentine's Day of this year. But watch this. On the same day, there was a brother named William, also 27. He was a civil engineer, husband, father of two children. He too was laid to final rest at a cemetery just outside of Houston, Texas. And I'm telling you right now, when these two brothers passed away, everybody was sad. It was a heartbreaking thing. So young, gone too soon, leaving behind a beautiful wife, beautiful children. It was just a sad occasion that they both passed away. They didn't know each other, but they were in the same situation. They both passed away and had their funerals on the same day. And they left behind a wife and two kids. And I'm telling you right now, when that happens, this is what's going through some people's minds. Man, I hope Jay had enough life insurance. Brittany and the kids are going to need it, right? And then they're going to be saying, do you think Will had life insurance? It's going to be rough on Keisha and the kids if he didn't. And so these are things that run through people's minds and thoughts. Heck, I think it all the time when I hear about somebody passing away prematurely. I just think about it, man. I hope the brother I hope the sister has some life insurance, because I understand that jobs don't keep sending paychecks to families when people pass away. Y'all do know that, right? You say you love your job and you think your job loves you, but your job doesn't love you enough to keep sending that paycheck or direct depositing your money into your account if you pass away. That stops. So people are concerned. They're saying, man, I hope they got life insurance. Y'all stay with me. I'm going somewhere with this. But check this out. They did have life insurance. Jason had $175,000 in life insurance. Hey, at least the brother had something. But watch this. William had $1 million in coverage on his family. But here's the thing, guys. Look at this. Here's the backstory. They both took out their policies at age 25, took out their policies 1 month from each other. Both policies was written at the same rate class, meaning that nobody was extra preferred and somebody was tobacco. No, same rate class. Both paid the same monthly premiums of $160. Y'all just missed it. Both took out their policies at age 25, took out the policy within 1 month of each other, so that had no bearing on the cost. Same rate class, paying the same premium, but family totally different face amounts. One had 175, one had $1 million. But here's the deal. One was whole life and the other one was a 35-year level term with waiver of premium. Check this out. See, life insurance provides for this is directly out of the book. Life insurance provides for the future economic value of a person's life in the event they do not provide it themselves. Meaning that if they pass away, life insurance is supposed to provide the future economic value of your life in the event that you die prematurely. Life insurance should not be bought as if you're going to live for the next 30, 40, 50 years or more. Have y'all ever heard people say things like, well, I don't need to necessarily buy no, man, I ain't gonna die no time soon, bro, so I don't need no life insurance right now. Have y'all heard people say stuff like that? Well, if you haven't, trust me, you will. Because they have this misnomer of thinking that life insurance is supposed to be bought later on in life. Later on, Raquel, but that's not the case. Check this out. Life insurance should be bought as if you're gonna die or become uninsurable tomorrow or even today. That's how you should buy life insurance. And that's how we need to be talking to our clients about buying life insurance. What if you pass away today? Or what if you pass away tomorrow? How much coverage do you need? That's how it should be bought. And watch this. Life insurance industry, the industry at large in the United States has de-emphasized the actual purpose of life insurance by discouraging the sale of term, which is pure protection. So they've de-emphasized the actual purpose of life insurance for the sake of making money. See, if one company paid a death claim of $1 million, listen to this, in the case of Will, and you had the other company paid a death benefit of $175,000 in the case of Jason, both companies could afford to pay $1 million. Both companies could afford to pay $1 million, but there's an $825,000 discrepancy. And that's what goes on when it comes to whole life policies. You multiply that discrepancy by millions of policies that are sold over the past century, and that accounts to an unfathomable amount of money that the life insurance industry will never have to pay out because the agent chose on purpose not to sell the client the coverage they need, but to sell them a type of product that's going to leave them underinsured and that's going to pay them the most money. Y'all ain't hearing me. That's what's going on, Alicia. That's what's going on. And so there's millions, billions of dollars that'll never get paid out maybe even trillions, and they never get paid out because an agent was trained and taught to sell people the wrong types of policies, even to this day. And so let's talk about whole life insurance. We're going to talk about it. How does it work? Let's say that a person has $175,000 in coverage. They're paying $160 a month. This is Jason's policy. $175,000 in coverage, paying $160 a month. So this is how whole life works. You have the coverage amount, and then you have what's called the cash value. The cash value is also called the savings. You'll hear me talking about both of them. They're one and the same. Cash value, savings, cash value, family, they're one and the same. And so when a client pays their premium each month, that $160 should get broken up into those two buckets, right? To where you got a portion of that $160 that goes towards the cost of the life insurance. Now, that cost for the life insurance stays the same for the life of the policy. That cost doesn't change. It's a fixed cost, the cost of the life insurance. But then you have another bucket, which is the cash value or the separate account or the savings. And how that works is that part of the premium is supposed to go over there. And it's designed, listen to this, you got to know this. The cash value is designed to be approximately 50% of the face amount when the client turns age 65. That's how the premiums are structured. That's how it's calculated, how it's tabulated. A person's premium amount is designed at the time a client turns age 65, they want the savings portion to be approximately, it might not be quite 50%, but it's going to be around 50% of whatever the client's face amount is. So at age 65, Jason's policy would have had approximately $87,500 in the savings. And let me tell you something right now. It's a lot of this that's out there. Does everybody got it so far? Are y'all with me? They got he has $175,000 in coverage, paying $160 a month. Part of the $160, Catherine, goes to pay for the life insurance. The other part goes into the savings. He doesn't know it's being split up. He was told that he gets these things, but that's how the insurance company separates them out. Everybody with me? Ireland, you with me? Good deal. All right, check this out. This is where it gets interesting. So this savings portion right here, they make this sound really attractive. They say, hey, this money over here, you can use it for emergencies, kids, college education, your retirement. You can take a vacation. You can make a big purchase. You can invest the money. You can do whatever you want to with it. This is your money, right? And Super J, check this out. This is what enemy agents may say to sell whole life policies. Listen to this. Hey, this is a permanent life insurance policy. Just like the name says, this policy will give you life insurance for your whole life. This is a whole life policy. This policy will give you life insurance for your whole life. This is a permanent life insurance policy. Something that an enemy agent may say to sell this policy. Hey, your monthly premium amount will never change. You will never have to worry about your premium payments going up. Has anybody heard that? Yep, absolutely. Check this out. This policy builds cash value, and the cash value works like a savings. Yay! You can use the money however you want. Every time you pay your premium in a whole life policy, it's like you're building equity in your policy. Just like every time a person pays their mortgage, they're building equity in their home. These are things that an enemy agent may say to your aunt, your brother, your sister, your parents, your best friend, listen to me, to sell them this policy. And then once they say the whole, you're building equity in your policy, kind of like a mortgage, you're building, every time you pay your mortgage payment, you're building equity in your home, they may add a neg tag when it comes to term insurance. Do y'all know what that neg tag is? It's kind of a word that I made up. A nega tag is well, they'll take a little haterous dig at term. See, term is like you're renting insurance. You're renting policies. See, when you have whole life, it's like you're owning the policy. See, so let me ask you something, Mr. and Ms. Klein. Would you rather rent or would you rather own? Oh, I'd rather own. Yeah, you need a whole life policy. That's what you need. Because it's better to own than to rent. See, when you have a term policy, you don't own it, you're renting the insurance. I'm telling y'all, this is how they selling it. This is what they're saying. What else? Julia gonna like this one. See, the cash value is liquid to use however you want. You can use it for emergencies, retirement, kids' college education, to start a business, et cetera, et cetera. See, you pay one premium, but Mr. and Mrs. Klein, you get two benefits. See, you pay in $160, and you're not only gonna get coverage, but you also get a savings. And that cash value, that savings is liquid to use however you want. You can use it for emergencies because emergencies happen, retirement, kids' college education, to start a business. You can use that money for whatever you want. Do you know that Tyler Perry started his empire from a cash value? Like, do you know Walt Disney started Disney World and Disneyland from a cash? Do you know that Master P started No Limit Records from a cash? Telling y'all, that's how they selling it. That's how they selling it. And the people who don't know any better, man, we ain't taught this stuff. It sound good. If you didn't know about the insurance, somebody came and rolled up on you talking about this, you'd be like, yeah, man, give me one of those little policies. Yeah, give me one of them. How much is it? And then they say, well, how much can you afford? Oh, I can afford about $150 a month. And they go and they look calculate, blah, 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 blah. Okay, well, you can afford $89,732 in life insurance. See, have y'all ever noticed whole life policies be just random amounts? They just be like, it don't be no clear amount. It just be like $87,349.72 worth of life insurance. That's what your $150 could buy. They calculated it down to the cent. Because they weren't trying to get you the coverage you need. They were trying to say, how much can you spend? Because they know the first year the premium gonna come to them. And that's how they selling it. But this is what you should say. Oh, I forgot about this one, Super J. See, this is the big one right here. See, Mr. and Mrs. Klein, the cash value is tax-free. Oh, you get tax-free money. You don't have to pay taxes on the money. We love tax-free money. Uncle Sam can't touch it. The government can't touch it. The money is tax-free, Marcellus. Can I get an amen? Can I get a boom shakalaka? And all of our people, your aunt, your cousin, everybody saying boom shakalaka. Sign me up for the tax-free. Yeah, I want tax-free money. And they get in the policy. Well, let me ask y'all the question, family. This is a question. They saying the money is tax-free, but is it really tax-free? Man, I think that this right here, what I'm about to show y'all, is one of the biggest lies or misrepresentation. See, that's an insurance word. See, Alicia just passed her life insurance exam, so she understands that misrepresentation. That means that you lied on the application. This is one of the biggest misrepresentations. Let me ask y'all the question. I got to illustrate it. I know y'all don't believe me when I be saying stuff. Let me ask y'all the question. Do you pay taxes on your income tax refund check when it comes to you? Do you have to pay taxes on it? Do you? No. If you don't know, no, you don't have to pay income tax. Let me ask y'all, why don't you have to pay taxes on your income tax refund? Somebody come off mute and tell me. Why don't you have to pay taxes on it?
Because it was an overpayment. It's your money.
Oh, what?
It was an overpayment.
It was an overpayment. It was your money to begin with, and that's why you don't have to pay taxes on it. So here's the deal. Are you really getting tax-free money in a cash value policy? Or is that just your money that you overpaid? That they telling you that you getting tax-free, but it ain't really tax-free. The same reason that they don't tax your income tax refund is the same reason why your cash value is not. See, y'all ain't hearing me. Y'all ain't hearing me. Because it's your money. Anyway, it's your money. It's your bread. It's your money. It's your money. All right. So here we go. So this is what you say when someone has a whole life policy. This is where you want to really take notes. And this is where you want to listen to this training again and again. You want to watch it because you want to get these things down and you say them in this order, right? Let me stop sharing. When you come across somebody who has a whole life policy, they have a whole life policy. This is exactly what you say to them as close as possible, as close as verbatim as you can in this order. Family, I'm telling you right now, you don't have to try to figure it out. Julia, you don't have to wonder. This, I'm telling you right, this is what you say in this order. Now, there might be some things that your coach or RVP might throw in there and you say, hey, use that too. But these are the things that I say. These are the things that I say that works for me whenever I'm dealing with somebody that has a whole life policy. And we're going to go through them line by line. First question you ask, okay, you have a whole life policy, great. Let me ask you a question, Mr. and Mrs. Client. The person who sold you this policy, are they a family member, friend, church member, or are they just a regular person you had no prior relationship with? That's an important question. Why is that an important question? Super J, talk to me, man. Why should we ask that question?
Well, you're asking that question because you're looking to establish the relationship with, if there is one, with the person that sold that policy to them, you know, because a lot of times these bad policies are being sold and they were sold to them by someone they hold in high esteem. You know, it could be their dad, it could be their big brother, big sister, you know, somebody who just has major influence in their family. And so it's a very, very important question to ask so you can know how to step and approach next.
And we just had that situation a couple months ago with one of my coworkers. Her brother sold her a policy. It was a term policy, but it was a rate of return.
It was a return of premium.
A return of premium, and we were able to give her double the coverage for the same amount of money she was paying. But her brother sold her that policy, and she was gonna stay with him. I mean, it's that loyalty, that family.
Loyalty to a fault, y'all. Loyalty to a fault. But we can only help those who want to be helped.
Facts. Facts. And that's the truth. I want to know who sold them the policy because just like Justin and Brittany said, if there is a connection and a close tie to that person, I know that that's going to be an emotional hurdle that I'm going to have to try to climb. And I know that when I show them this information and break down their policy, that they might feel pretty bad about it. And they might be a little bit upset. And I don't want to mess up Thanksgiving like that. Are y'all with me? I don't want to mess up the niece birthday party or the nephew birthday party that's coming up where they gonna see each other. I don't want to mess up Sunday dinner like that. But look, I'm gonna tell them. They say, yeah, my uncle sold me this policy. Is he close uncle? Yeah. Okay, listen. I'm gonna go ahead and give them some grace. Hey, I'm gonna show you some things about the policy. We're gonna talk about some things with the policy. Maybe your uncle didn't know what he was selling, or maybe your brother didn't know what he was selling. But there might be something that's out there. Matter of fact, I know there's something that's out there that you can get more value for the money you're spending. If I can show you that, do you have any challenge in upgrading the type of program that you have that your brother, your uncle, or your cousin, or your best friend sold you? And I need that answer. They need to say, yeah, I don't have no problem. Look, man, if you got something better than what my brother sold me, I'm cool with changing. I need to know that. And you need to know that. Are y'all with me? When somebody has a whole life policy, I'm putting it back up on the screen. Ask this question. Hey, I see that you have this policy. You got a whole life policy. Okay, cool, man. Who sold you that policy? Is it the family member, friend, regular person, had no prior relationship with? Oh, had no prior relationship with him? Okay, sounds good. Okay, cool. All right, so this is the next question. First, this is a statement, I'm sorry. First, let me commend you for having life insurance outside of your job, because most people don't. And by having it, that says a lot about you and how responsible you are and how much you love your family. See, you got to pay the client that compliment. You got to do that. Because even if they have the wrong type of policy, guys, that's not their fault. It's what was sold to them. But they had the wherewithal, listen to me, to actually get a policy outside of their job, Angel. So you got to tell them, hey, man, big shout out to you. First, let me commend you for having a policy outside of your job, because I do this, and I sit down with a lot of people, and unfortunately, most people do not have a policy out there outside their job. But the fact that you do, that speaks volumes about you and how responsible you are and how much you actually love your family. See, I need to bring them in. Are y'all with me? I need to bring them in. You need to bring your clients in, because you're about to tell them that they bought the wrong thing. So you don't need to just rain all of that down on their head. Yep, you made a mistake. You thought you were doing the right thing, but no, you didn't. You spent your money on this wrong. No, you need to tell them, man, look, it wasn't your fault. You did the right thing. It's just what was sold to you. You ain't had no control over that. Are y'all with me?
Hey, coach, just to add to what you're saying, it is important for us to reassure the client, because the client is going to beat themselves up anyway. They're going to beat themselves up. If they've had it for X amount of years and they've been paying faithfully, right? And then they find out this new information, it's a huge guilt trip, because they're like, how did I buy this? How did I do this to my family? You know what I'm saying? And so you assuring them and letting them know, hey, no, you did the right thing by getting life insurance on your family. Your heart was in the right place, right? It's just, hey, this is just what happened. You know what I mean? And I always let them know, hey, the insurance company, they always honor the contract and not what a person says. So if your agent is saying one thing, the contract is saying something else. So the insurance company will always honor the contract. So I always let them know that, hey, you did the right thing. And then I let them know that in Primerica, what we do, we feel that the best client is the most educated client, right? So we assure them about that. Like, we're big on education, big on you knowing exactly what you have and why you have it. So that was my piece.
Powerful, powerful. Awesome. Next question. Mr. and Mrs. Klein, did you buy this policy for protection, for the savings, or both? Because you need to understand where they're coming from, family, and why they bought the policy. I'll be honest with you, most people are going to say for the protection, because most people in our community, they're not buying life insurance to create wealth, or they haven't bought life insurance to create wealth. Some of them are trying to do that. You'll find some people that are, too smart for their own good, and they might be saying, yeah, well, I bought it for both, right? But most people are going to say, hey, I really bought it for the protection. Rarely will people say, I just bought it for the savings. You'll get either I bought it for the protection or I bought it for both. But you got to ask that question, because you need to know where they're coming from. What was their thought process for buying this policy? Hey, did you buy this policy for protection, for the savings, or both? All right. And then regardless of what they say, the next question is you ask, did your agent explain how the savings portion works? And you listen to them. Well, they told me a little bit about it and this, that, and the other. Some of them will tell you flat out, no, they didn't tell me how it works. But regardless of what they share with you and what they say to you, you take that in and you listen. And then you say, see, when you get this type of policy, Mr. and Ms. Klein, you actually have not only life insurance, but you also have a savings bundled together. They call that savings to cash value. See, our company, we believe in having insurance and savings as well. We just believe in keeping the two of them separate. This is what you're saying to them. You say, hey, look, because most people don't know what they have. They don't know how it works. And this is where we come and educate. We say, hey, when you have the type of policy, you have this whole life policy, when you have a whole life policy, you actually have a life insurance and a savings bundled together, right? So when you pay your premium, it should go to those two things. Now, I'll be honest with you. We believe in having life insurance and savings also. Our company, we just believe in keeping them separate. And then this is the next thing you see. Because unfortunately, when you bundle life insurance and savings together, you give up control of the savings portion of the policy, which is the cash value, to the life insurance company. Now you got their attention. Now you got their attention. I'm gonna read that again. Unfortunately, when you bundle life insurance and savings together, you give up control of the savings portion of the policy to the life insurance company. What does that mean? What that means is that the insurance company has the audacity, and you got to stress that, has the audacity to start treating your money, which is the savings, like it's their money. Let me explain. Who do you bank with? I'm gonna stop right there. Do y'all got it? Do y'all have it? It's 7 bullet points that leads you right into you having the client's full attention on what you're about to share with them. Those 7 bullet points. You can be in front of somebody looking at their policy. You can be having a conversation about life insurance at random, but you remember the flow of those 7 bullet points, you got their attention. Give me a thumbs up if y'all still with me. That's it. And so watch this. So there's something in this business that's called story selling. See, you can't just tell people that whole life policies are bad. You know, you can tell them that, but if you say it, they don't trust it. But if they say it, it's true. So a lot of times when you're talking about a really interesting concept like life insurance or a financial matter, you got to tell a story. You know, it's no wonder that when Jesus was talking about heavenly principles and, you know, the kingdom of God, he used parables. Are y'all with me? To try to explain it, because it's a really difficult concept to just say, hey, this is how the kingdom of God is. No, people have to try to relate it to something that's everyday, ordinary to them. Are y'all with me? So you're going to do the same thing to explain the 4 evils of cash value life insurance. Everybody hold up the number 4. How many of them? 4. There are 4 evils to cash value life or trash value life insurance. 4 evils, right? And what we use is their bank. You say, who do you bank with, right? I bank with Chase. Okay. And this is story selling, guys. Story selling. I say, hey, let me pick a person. I say, hey, Fendi, check this out. Fendi, you don't have to come off mute. I'm just going to I'm going to answer for you and all that good stuff. And we'll just talk through it, right? We'll talk through it. All right. I say, okay, Fendi, okay, you bank with Chase. Okay. What if you were at Chase and you were in there doing your business and all that good stuff? And let's just say one of their personal bankers just tracked you down and said, hey, Fendi, check this out. I know you've been a client of our bank for many years. I want you to come sit down with me because we have a new account and I want to share the features of that new account with you to see if you want to open this account. And you say, cool, what you got? All right. And so you sit down in his cubicle and he says, okay, all right, there's 4 features that I'm going to tell you about this account. I want to know if you want to open up this account. The first feature is, you may not like this, but I'm going to sell it anyway. When you open this account and you faithfully deposit money into this account, for the first 2 to maybe even 4 years that you faithfully deposit money into this account, you're still going to show a 0 balance. You're still going to show a 0 balance. For the first 2 to 4 years that you have this account open, you're still going to show a 0 balance. Do you like that feature? And I'm shaking my head no when I ask the client that. Do you like that feature? Everybody shake their head no. Say wherever you at. Ask them, do you like that feature? Let me see you say, do you like that feature? Shake your head no. Because you're giving the client permission to say, no, I don't like it. Do you like that feature? No, I don't like it. Okay, I didn't think you did. Because why don't you like that feature? Would I dare say that you're wondering, where did your money go? Right? Wouldn't it be safe to say that you want to know, hey, if you put money in this account faithfully every month or 2 years, where'd your money go? What if the personal banker said, well, the money's going to go into my pocket? Because I opened up the bank account for you. So instead of it going into your savings account, it's going to come into my pocket as my commission. You might not like that, right? And you're going to say, and they're going to jump and say, no, I don't like it. Okay, all right, cool. Well, if you don't like that, maybe you'll like this one. So once you do start showing a balance in the account after the first 2 to 4 years, if you want to take money out of the account, you cannot do a withdrawal from the account. Fendi, you have to do a loan. So it's your money, but to take it out, you don't withdraw it. You have to borrow your own money and pay us, Chase, back 6 to 8% interest on the money that you take out of your account. And that interest gets credited to Chase. Do you like that feature? And Fendi, I could probably say, you're gonna let me say, you don't like that feature. And we shaking our head no. Everybody shaking their head no? There you go. Shake your head no. You don't like that feature. Okay, you don't like that feature. Now, if you take money out, it's a loan, gonna charge you 6 to 8% interest, but the money that does stay in the account, it will grow at about a 2 to 5% rate of return. So if you take money out, we're gonna charge you 6 to 8, but if the money stays in there, you're only gonna grow at 2 to 5%. Doesn't that seem like an imbalance, right? You don't like that feature, do you? No. But I know you didn't like the first 3 features, but here's the kicker. This is the last feature. You know how people fight over money sometimes when people pass away? Well, you don't have to worry about that, because if you have money in this account, and if the unthinkable happens and you pass away, whatever money you have in this account, it will not go to your family. We are going to keep that money. Chase will keep the money that's in your savings account. With this type of account, we're going to keep the money. And so I have a question for you. Do you want to open up this account? Now, when you tell that story to a client, what do you all think that they're going to say? What do y'all think they'll say? No.
There will be no whole life policies that exist.
Right. Nobody would open up that account if they knew that that account would work like that. And they'll say, no, I don't want, I wouldn't open that account. And if your client, the person you're sitting down with, has a whole life policy, then you say, well, guess what? You already have. Because that's exactly how the savings portion of a whole life policy works. And the eye is going to get big. And so that's when you start breaking it down. See, check this out. See, when you have a whole life policy, for the first 2 to 4 years, you're faithfully paying your premium. Part of the premium should be going to pay for the life insurance. The other part should be going into the savings. But for the first 2 to 4 years, that money goes into the agent's pocket as their commission. That's why they sold you that policy. They didn't tell you that, but that's what's going on. And then once you do start showing a balance in your policy, if you want to take money out of the cash value, they say that you have to borrow it, which means that it's a loan. And they're going to charge you in the ballpark of about 6 to 8% interest on the money that you take out of your account, which begs the question, whose money is it really anyway? If it's your money, why should you have to borrow your own money? Does that make sense? And then pay them back interest on your money. And then it'll probably grow at a rate of return of about anywhere from 2 to 5%, less than what the loan interest rate will be. But then here's the kicker. When you die, they will pay out the face amount of your policy, but they're going to keep the money that's in the cash value, because the cash value, the savings part of your policy, is considered a living benefit and not a death benefit. It's a living benefit and not a death. So it will not get paid out to your family. So any money that's in the savings, the insurance company is going to keep it. And so if you knew this prior to buying your whole life policy, would you have bought that policy? Or if a person doesn't have a policy, but they're just asking what's the difference, you say, knowing this information, now that you know, would you buy this type of policy? And what do you think they're going to say? No, I wouldn't buy that policy, because now they have the facts. Now they have the facts. And that's how you explain the 4 evils of cash value, trash value life insurance. Don't start showing a savings balance for the first 2 to 4 years. Money goes into the agent's pocket. That's number 1. Number 2 is that you can't withdraw the money. It's a loan, which means that you got to pay the money back with interest. That's number 2. That's your money that they're making you borrow and pay back with interest. That's number 2. And here's another thing. Whatever you take out of the cash value, it lowers your coverage amount by that much. So whatever you take out of the savings, it reduces your coverage amount by that much. Crazy. Number 3, your money grows at a very low rate of return, 2 to 5%. And then number 4, this is the kicker. This is the evil of trash value life insurance. When you die, the insurance company keeps the money that's in the savings. Now, if you hear somebody saying, what are the 4 evils of cash value life insurance? Now you all know. Give me a thumbs up if we good. Everybody still with me? All right, perfect. We good. All right, so it's one thing to hear Nick talking about it. It's another thing to actually see what a policy looks like. So when that policy is in front of you, what do you need to be looking for? It's just a bunch of papers and words and all that type of stuff. You see the company logo, you're like, oh, Jesus, like, okay, this thing is, okay, what do I need to be looking for? I'm about to tell you. When you have a whole life policy in front of you, what should you be looking for? These are the parts that you need to be looking for. First of all, you need to verify what type of policy it is. Make sure that it's a whole life policy, because sometimes clients can say, I got a whole life policy, but they might have a universal life policy. Just make sure you verify what type of policy, or it might be a return of premium policy, a return of premium term policy. Like, just verify the type of policy. You also need to verify who's insured on the policy. You need to look at the rate class, the insured's rate class, coverage amount, which is the face amount. You need to look for that. You need to look for the policy issue age and the issue date. What was the age of the client when they got the policy, and what was the date that they got it? Why do you need that information? Because if they got the policy 10 years ago, you're not going to be able to compare apples to apples, right? Because you're quoting them at their current age, but they got the policy 10 years. Are y'all with me on that? So there just needs to be an understanding of, okay, when did you get this policy? You got this policy 10 years ago. And I'm telling you right now, oftentimes, and Super J, he can attest to this, we'll come in 10 years later, still being able to get the client more coverage for less money that they got in that whole life policy 10 years ago. Y'all ain't hearing me. We can still do that. It happens all the time. It happens all the time. And it's mind-blowing. That's how much that stuff is trash and how much they overcharge people. We come in 10 years, like they 10 years older, we coming in still giving them more coverage, and they're going to be paying less premium with us. Crazy. You need to know what the cost is. What is their monthly premium? All of this stuff is in the policy. What is the cash value growth interest rate? Now that you might have to look for that. It might be there, it might not be there, but if you can find it, that's a good thing to find out. What is the interest rate that the cash value is growing at? They might list it on there. And then when they take a policy loan, what is the policy loan interest rate? You want to look for that. The cash value accumulation table. These should be fairly easy to find in a whole life policy. The cash value table, that's what you're looking for. And then also this last page, the death benefit provisions page. This is the page that spells out how the death benefit and what death benefit gets paid out when a person passes away. You want to look for that. These are the things that you want to look for in a policy, right? And so if you have a policy in front of you, before you start breaking down the policy to the client, take a second to say, hey, let me look at it real quick. Or if the client emails you their policy, you're looking for these things and you're looking to find them. And you just you say, hey, can I make some notes on your policy? Yeah, go ahead. Cool. You're just making notes. You're picking these things off, Julia. You find them. So that way, when you start talking about the policy, you already know where everything is. Are y'all with me? That's how you do it. And so let's look at a policy. So this is a policy, Metropolitan Life Insurance, right? The face amount. Okay, what are we looking for? We're looking for what type of policy it is, right? There it is. It's a whole life plan. Got it. Whole life plan. It was on the front page, right? Next thing we're looking for, that's just a little benefit right there. It just kind of stands out. This says life insurance payable when insured dies. Did it say the cash value is payable when the insured dies? See, Justin just told y'all this thing is only going to do what's in black and white. It says the face amount is payable when the insured dies. The life insurance is payable when insured, not the cash value, right? That's just a note. And then on this page, check this out. You find what the insured's age is. They're male, 28 years old. Policy issue date was March 12, 1993. Face amount of the coverage, $150,000. The policy the page didn't get included, but the monthly premium that they're paying is $121 a month and 28 cents. So we got that. That's the monthly premium. Then we're looking for the cash value accumulation. Okay, oh, wait a minute. Guaranteed interest rate. This is the interest rate that they're getting on this policy, on their cash value. They're getting 4% a year. Okay, we found that. Then we're looking at the cash value accumulation table. See, y'all think that I was playing. Y'all thought I was playing. Look at that column that says guaranteed cash value. In year number 1 and year number 2, what is the balance that's in the cash value? They're paying $121 a month. What's the balance? 0. See, it's in black and white, y'all. Client doesn't know what they're looking at. They've never read their policy before. It's just right there. We're not making it up. We're not just out here just trying to hate on trash value life insurance, calling it bad. No, it's showing you that it's bad. For the first 2 years, this client has been faithfully paying $121.28 a month in their policy, and they still show a 0 balance after 2 years. The money went into the agent's pocket. And then in the 3rd year, they have the audacity at the end of the 3rd year, they only got $150 in their policy. That's all they got is $150 in the savings. So if I do the math on that, Shadrika, check this out. If I do $121.28 times 36 months, this client has paid $4,366.08 into this policy to only have a whopping $150 in the savings. Y'all think I'm, oh, and this is what they talking about. This is how you create wealth. This is the best thing. Got your cousin all excited about it. And your cousin ain't even read their policy. You jump on their policy, you be like, let me show you. I know you're excited. Auntie, I know you don't have to do the hallelujah dance. Hold on a second. Let me show you something real quick. Oh, come over here. Come over here. I'm gonna show you something. And you show them this, you're gonna be able to really bless them. Let's talk about the policy loan. Talking about that. What does it say? It says you can get cash from us by taking a policy loan. If there's an existing loan, you can increase the loan. The most you can borrow is the cash value at the end of the current year, less any unpaid premiums for that year, and the loan interest to the end of the year. The loan may be taken if the extended term insurance. Loan interest is charged at a daily rate we set from time to time. I'm not making this up. It says the loan interest is charged daily at a rate that they set from time to time. You take a loan out on your life insurance policy, you don't know what interest rate that they're charging you because they set the rate from time to time. And it says the rate of interest we set for the policy may not be more than or higher of the published monthly average for the calendar month ending 2 months before the start of the policy year. The rate we use to compute the guaranteed cash value of this policy. Does anybody know what they're saying? And you're not supposed to, because they can charge you whatever they want. and this is your money. That's what's going on. And then check this out. Payment when the insured dies. When the insured dies, the amount of money called the insurance proceeds will be payable to the beneficiary. The insurance proceeds are the total of the face amount of the insurance plus any this, minus any premiums due and any policy loans and loan interest. So if you have an outstanding loan on your whole life policy, they deducting that from the face amount. Notice that they did not say anything about cash value being part of the death benefit. Do you see anything in here about cash value, savings, accumulated value, anything like that? Nope, because it's not part of the death benefit. It's a living benefit. Nothing about the cash value. That is not a death benefit. So you're paying for two things, but you only get one. You only get one. And so the policy cash value while the insured is alive. The cash value is the total of the guaranteed cash value, this, that, and the other. Take a loan from us. You can surrender the policy to us for its full cash value. So you mean to tell me that if I take all the cash out of my policy, I give up my coverage? I don't have any life insurance coverage anymore. I surrender the policy. If I take all the cash out, I don't have any coverage anymore. But if I die and I got money in the savings, my family don't get the savings, they just get the face amount. Whose money is it supposed to be? It's supposed to be my money, right? But they treating my money like it's their money because I gave up control of it to the insurance company. And we start talking about infinite banking next week. They tell people to dump a whole bunch of money into the policy when they started. It ain't so it's for you, it's for them to get super paid. That's really what's going on. And this is how you break policies down to people. So let's talk about buy term and invested difference versus whole life. So let's just say that you got John, he's 28 years old, he's got 150,000. This is that same client paying $121 a month. Remember, he's 28 years old, 150,000, paying $121 a month. What did we say that John's cash value should be by the time he turns age 65? Does anybody remember? Does anybody remember?
50%.
Oh, there it is, Kimberly Lewis. Approximately 50% of his policy, of his coverage amount, that's what he should have in his cash value. All right. So if he continues on that path, by the time he turns age 65, John should have approximately 75,000, right? And if he didn't know any better, he would think he was sold the right thing until we come along with our buy term invested difference concept. For that same $121, we can get John 300,000, double his coverage on a 35-year level term, only cost him $50. Y'all ain't excited. $50 for double the coverage. And then with the difference of $71, that 50 plus that 71 makes up the 121. We invest that for the next 35 years that runs parallel to the term. We invest that. Let's say it averages in those 35 years just a modest 9% rate of return. By the time he turns age 63, he should have almost $210,000, over $210,000 in an investment. And guess what? If he keeps the whole life policy, if John dies, his family will get this $150,000, whatever amount that's in his savings, they will not get that. But over here, if along the way, if John dies, his family will get the $300,000 and whatever he has in the investment. Why? Because they're two separate things. And then when he gets to the end of his term in 35 years at age 63, he can decide whether or not he wants to keep some life insurance or he can position this $210,000 to be self-insured. To be self-insured. And so let me ask you a question. If it was being sold to you, these two strategies, which program would you buy? Which one would you want? Would you want the whole life policy standing non-tobacco, or would you want the buy term and invest a different strategy? Let me tell you something. I know which one your family would want. Because if you die, do you want your family to receive a check for $150,000? Or do you want them to receive a check for $300,000 plus what's in the investment? It ain't magic, it's just math. That's all it is. But here's a better question right here. Which program would you sell to your aunt, to your cousin, to your church member? See, which one would you sell? Hopefully you say you'll sell the buy term and invest the difference because that's why you're here. But that's a question that I don't think a lot of these people have been given. Which one would they sell? See, we know what they're selling, and they're selling the other side. And that's why it's a disturbance in the force. But the real question is, which one would you sell? Because that's what we have a responsibility to go do, is that we're going to go offer the right thing for people, the complete strategy to help people make the best choice and the best decision. All right. Oh, family, I got to leave off right there, man. I got to stop it right there, Super J. Oh, man. Hey, next week, check this out. We're going into Universal Life, go get into infinite banking. I got to show y'all a Universal Life policy from a personal friend of mine. He's been my friend since sophomore year in college. He was my best man in my wedding. We're switching out 2 Universal Life policies for him. I'm going to show you guys some pages from his policies. These are real. It's going to mess you up. I'm going to repeat that. It's going to mess you up. Man, I want to spill the beans so bad, Super J. I ain't going to do it. Come back next week. We're going to go over Universal Life. We're going to take a deep dive into that infinite banking crap. And I'm telling you right now, we're going to put it to bed. We're going to cut his head off right there. Next week. It's over. It's up. It's a wrap. And I want you to be in a position to where you can watch this and listen to it over and over again. Know what to say. Know how to explain it as a story to get clients to understand that that's not good for them. And how what we do and our strategy and our approach to insurance and savings and investment is better. Not because it's going to pay us a bunch of money. No, because it's going to pay their family a bunch of money. And that's all I got. Appreciate that, teammate.